Now that the election's over, is the real estate market finally going to crash? Well, that's what we're talking about right now. Hi again, this is Vito Scarnecchio with the Abitano Group, powered by Coldwell Banker. If you haven't done so already, make sure you take a quick second to hit the subscribe button and hit the little bell to be made aware of upcoming videos. We do new videos every week and we'd hate to see you miss any of these great videos. So today you're watching this video wondering if the market's going to crash. And the truth is we just don't know. There's a lot of indicators that possibly it could happen. We just don't know because we don't have a crystal ball. And unfortunately, that's just the way it is. The indicators, however, do show that we are due for some kind of market correction. And that's what we're going to go into a little bit more today. So the real estate market really is dependent and a part of our US economy, and that's our GDP. And when the market collapses, when the economy collapses, a lot of things will need to trigger that for that to happen. So right now our stock market is sky high. It's the highest it's ever been. Our housing market is the highest it's ever been. Our medical industry is the highest it's ever been. But other industries are kind of shuddering and shaking a little bit or plateauing. And that's an indicator stating that there's some things kind of ebbing and flowing inside the economy. So when the economy finally does crash or have a correction, a lot of things happen. The stock market will go down, mainly because the consumer or the market loses confidence in the stock market. And that happens simply because earnings aren't set to what projected for growth for those specific companies. And that really means that, the big car manufacturers and big box retailers and some of the tech just don't hit those earnings that they're projecting or hoping to get to. So they ultimately lose confidence in those stocks, and that will help trigger a decline in that market. Some of the outlying ideas of what's happening though is once the stock market goes down, the economy goes down, that means people are going to start losing jobs, right? And at the height of COVID, we had something reported like 30% unemployment of employable Americans. That now went down to 15, and I've seen it down to like 3 and 4. I don't know what numbers to really look at, but unemployment is very important in the economy as well. So because if you're not working, you don't have money to be able to buy things, and that's something that we're kind of talking about, but we're not really seeing numbers or reporting numbers as small and medium-sized businesses, how they're doing. And you hear this locally all across the United States about long-time restaurants and businesses shuttering their business after 30, 40 years of being in part of the community. This has a long-term effect. What's going to happen is those mom and pop shops go away. So there's no revenue being produced for those people, and they're no longer able to pay mortgage or rent or what have you. And that also means that retail outlet, that retail strip office is going to be left vacant. And I'm sure you're seeing this a lot. When you go get coffee, you see the dry cleaner going out of business or a little donut shop going out of business. So when that actually happens, the business owner stops making revenue, stops making income, but also sometimes they have 4 or 5 people that work for them. And those people are now unemployed. So that adds to the whole unemployment, which kind of creates a tipping point of this market, of this supposed crash that we're going to see. We have the small businesses, we have unemployment, we have big box retailers and manufacturers going out of business or lowering their expectations of revenue. Stock market kind of crashes. And but this all boils down to people have to do what they have to do to survive. And that means they have to feed their family. They might not be buying new clothes for people, which will further hurt the economy, but also they're not going to be paying rent or their mortgage. And if they're renters, chances are probably about 50-50 that they're renting from a mom and pop landlord. And that's another thing that could be an issue. If you go to one of those aggregate REIT sites, a REIT is a real estate investment trust where we gather millions and millions of dollars and we buy apartment blocks, we buy houses and condos and things like that. Those people can weather the storm a little bit better than mom and pop landlords. And a small landlord is considered anybody that has 10 units or less. That means they have maybe 7 or 8 houses or condos, maybe a couple duplexes. But what happens is those people that are no longer working aren't paying rent, and those mom and pop landlords aren't able to make the mortgage. Now you're like, hey Vito, we have this forbearance. Don't worry about the forbearance. The forbearance is going to take care of all that. It is, and it isn't. Right now, it's basically a lifeline to keep the economy afloat. It's preventing banks from going through the foreclosure procedure up until I think January or June, I don't know which number that is, 2021. But what happens after forbearance ends? Forbearance basically means that you are prevented from going through the foreclosure process if you're a homeowner or a landlord. Somehow, some way, that money that's not being paid has to be paid back to the bank, because that's the promise that you made when you bought a house or you bought a house as a rental. Now, some people will be able to package it on the back end of the loan, pay for it in 31 years instead of 30 years. They might be able to refinance. They might be able to do a lot of different things, but a lot of those people are still unemployed or have shuttered their businesses, and they have no intention or ability to pay back that money or continue or start back up paying those mortgages. So ultimately what's going to happen in January, June of next year is the banks are going to start rolling out foreclosure procedures on houses that haven't been made payable. And back a few months ago, I mentioned the fact that if you're having issues, talk to your banks often and early. And a lot of people probably haven't done that. And those people, the banks have no choice. They have to foreclose on it because it's an investment. They have to pay to their stockholders and stakeholders and make sure that they are made whole. It's just business. And it happened in 2008 and 2009. It's probably going to happen again. Now, is it going to happen right away? I don't know. We just don't know. What's going to happen to the landlords? What's going to happen to the unemployed worker that can't find a job? They're going to be forced to foreclose, walk away from their house, try to short sell it. So we're going to see 2009 again. I don't know to what depth. Are we going to have 30% of the houses on the market as distressed properties? Is it going to be 50 or 60%? We just don't know. People are going to continue to move. People are going to continue to have jobs, but there's that lower portion of American workers that won't be able to provide. And that's what we're looking at as a problem. Another thing that people aren't really seeing, because people are like, Vito, I'm just going to wait for the market to crash and then I'll buy a house. That's great. That's great. I don't have a problem with that. But just be aware that when that happens, a few things happen. When the market crashes, a few things happen. One, rates go up. It won't go skyrocket back up to 5 or 6 or 7%. It'll go up, but rates will go up because ultimately there's going to be more risk in the market, no matter who you are. Guidelines are going to tighten up. And guidelines mean you have to have more reserves, more down payment, better credit, better job history, that kind of stuff, right? There's a lot of things that go into that effect. Like, have you been laid off during the COVID thing? That's going to be probably a question that they're going to ask. I don't know if it's legal or whatever. And if you don't believe me, take a look at the link down below. They talk every day about what's going on in the fine tech industry. And they talk about all the high-level governmental procedures that are coming down the pike, just so you understand what's going on. There's a link down here to a Facebook TV show that they put on every day. This link will take you right to the one that triggered this video. So enjoy this. So taking this all into consideration, we went from big box retail manufacturers to mom and pop store owners, to unemployment, to the landlords, the mom and pop landlords that aren't going to be able to pay back, and how forbearance is going to affect you and how rates are going to affect you when it comes to refinancing or getting out of the whole forbearance thing or trying to buy a house as a new entrant, as a new home buyer. Even if you're selling a house and you're going to buy another house somewhere else, it's going to be a delayed process. We're typically seeing houses close anywhere from 20 to 30 days now. We can get it as close as 10 or 15, but generally speaking, we try to make it around 30. What's going to happen, and a lot of real estate agents that have been through this process have to understand this, when we say 30 days, the banks will tighten up their guidelines and they have to fine-tooth pick through every document and make sure every T is crossed and every I is dotted. And they just have to double check it and triple check it because those guidelines coming from on high, from the Fed guidelines, they're going to make it a lot more difficult for them to process loans. So a house could take 45, 60, even 90 days if it's a bad underwriter or the lender or the buyer isn't producing what needs to be done right away. What happens when the market crashes or when a correction happens? Because we don't know what's going to happen. It could be just like a little blip, right? And we go right back on our merry way. Highly doubt it. But I'm not an economist and I don't have a crystal ball. I'm not a fortune teller. What's going to happen? Prices come down, right? That's pretty obvious. That's why a lot of buyers are holding out, waiting for the market to crash. I could have sworn that was going to happen in September. And then September happened, and then I thought, okay, October. Now that I'm digging deeper into it, I really think that the forbearance ending is going to be the tipping point, and we're going to see it come to a head sometime in 2022. That doesn't mean you can't get a great deal in March of next year. Just have to weigh your options. But be advised, if you're waiting for the market, if you're going to time the market, understand that there's some other things that are happening. We already talked about guidelines tightening up, rates going up, right? But we also will have more competition. And we're not talking about first-time buyer competition. We're talking about investors. The market will be saturated again with investors. And that was a frustration back over the last cycle. We had investors coming in, spending $1 million cash on a house, and they have $1 million, $2 million cash in their bank account. And when you come in as an investor, you go, here's my $2 million versus you might wait 30, 45 days for a loan, and they have to go through the entire process. The risk is simple. You go with an investor, right? From a seller standpoint. But that makes it ultimately more frustrating for buyers entering the market. Even if you're a first-time buyer or a move-up buyer or even a move-down buyer, it makes it really difficult to compete with those investors. So rates go up, guidelines tighten, more investors hit the market, prices go down. So there's like this little dichotomy of, is it possible? Is it viable? Yes, it absolutely is. Just understand that if you go in to a house that used to be worth $1 million and now it's worth $600,000, don't expect to spend $600,000. You're probably gonna have to get it back up to $700,000 or $800,000. And that's what investors do. And that's what people do when they buy into this market. They hedge the market, understanding that they're not buying today, they're buying for a year or so down the road when it finally comes back up. Guidelines tighten up, rates go up, money's more expensive, but also you as a buyer, you need to take advantage of this time right now. If you're really gonna wait for the market to correct or crash, take the time to improve your credit. Take the time to save more money. Take the time to improve the guidelines. Talk to your lender. Find out what they're looking for specifically for a first-time buyer. Understand what they're looking for and what they assume that's gonna happen when these new guidelines come through. Is it gonna be, I need a 640 credit, or am I gonna need a 750 credit score? We don't know, right? Am I gonna need 20% down payment, or can I get by with 10%? Is the FHA gonna be as strict? What's that gonna look like? So there's a lot of different things you need to be aware of right now so you can plan for what could happen maybe in March or January or June of next year. We just don't know. All right, so some people ask me what the expectation is. What's going to happen when the market falls? We don't know. It could go down $50,000. It could go down $500,000 on the average in a specific area. And you look at Santa Clara County on the whole, we did decline a little bit. In this area right here in South San Jose, we saw a decline of probably $200,000 or $300,000 on the average when it finally ticked down. Came right back up in 2009, 2010, but a lot of people were freaking out because of that. In Palo Alto, it actually went up. I did a small appraisal. I do like these courtesy appraisals for a lot of my friends that own homes, and a buddy of mine who bought a house a year ago said, hey, I want to do this mini appraisal. So I went there, and his house actually increased in value $300,000 during the downturn. Wouldn't you know? That's because over there, that's the epicenter of the real estate market for our area. And what that means is not a whole lot of stuff really happens over there. If anything, they have a whole lot more money. There's a whole lot more VC money and startup money. We have a bunch of high-tech companies over there that really are doing well. They made it through 2008, 2009 pretty well, and they're going to continue to do that. So anybody that lives over there, works over there, probably can afford to ride it through. What happens over here is people hedge the market. They buy a little bit too high, they put too much money into it, and then they get unemployed, and then they can't refinance, or they can't adjust that forbearance, and then they have to sell. Whether it's they sell by the hair of their chinny chin chin and they just get out and make a little bit of profit or none at all, or they have to go to the bank and say, I have to do a short sale, which means that, let's say you buy a house for $1 million and you're all into it, meaning you owe $1 million, and the market shrinks down to $400,000, the bank has to take that $600,000 chunk. That doesn't happen. They're going to sell it for, $800,000. They'll take a $200,000 loss. But it affects that seller, that owner. And then the REOs, they walk away from it, and it affects their credit. The bank recoups as much as they can, and then they get federal bailout, so they're not really hurting. Real estate, there's always a willing buyer for any house out there. It has to do with location, condition, and price, right? And a lot of investors are sitting back waiting right now, just like a lot of first-time buyers are, ready to write $1 million cash check, boom, and close within 2 days or 3 days. And that can happen. The problem with buyers is rates go up, so money becomes more expensive, and ultimately you can afford less house. Well, that makes sense because houses go down. Not necessarily, because again, there's more competition, so a $600,000 house might go for $800,000 here in Santa Clara County. That's kind of how it goes. So you have to get in that mindset. Again, go back and talk to your lenders, find out what they're looking at, what they're assuming the guidelines are going to look like in 6 months. Because if you're really waiting, now is the time to strategically plan with your financial people, your lender, your financial advisor, and your realtor to understand what the game plan is if and when it does happen. That's it for now. I hope this makes sense. If you have any comments, comment down below. If you have any thoughts or questions, you can DM me, you can text me, do whatever you want. Just let me know how I can help you understand what's going to happen, because, well, honestly, we don't know what's going to happen, but at the end of the day, we can get through this together. I'm Vito Scarnecchio with the Abitano Group. We'll see you out there. Do me a favor real quick, take 2 seconds and hit the subscribe button if you haven't already. Also hit the like, the little thumbs up, and the little bell so you'll be notified of upcoming videos.